Good morning. Good morning. Welcome to the Daily Money Market. You are actually with me, Che Yusuf. So yeah, man. Today it's very interesting. We got a very interesting topic that we want to, share with guys and share with our viewers. The topic is about the inflation data. So the reason why we are going through, to talk about inflation data is being the talking, news when it comes to the finance market, when it comes to economics, and when it comes to the forex trading market. Everyone is being actually talking about inflation that comes from different areas. But what is this inflation actually is actually, what does it mean and how does it affect between you and me in our daily life basis when we are actually living. So inflation data, it actually occurs when the price of the goods and the services increase over a long period of time. So it actually occurs when the prices of goods and the services that is happening in that region and increases over a long period of time, causing your purchase power or the amount of goods and services you can buy with a single unit of currency to decrease. In a short, inflation means that your money may not be able to buy as much today as it could buy on the past. So that's what the inflation actually data, the inflation itself means. But what exactly does inflation rate tells us, when they're actually, giving us the rate. So whatever the context, inflation represent how much more expensive the relevant set for a goods or a service has become over a certain period of time, mostly commonly over a year. All right, now we're gonna try to break it down, so that we can understand, and we're gonna try to give it maybe a couple of examples and see how it actually, works. So when it comes to the inflation data, it actually comes from the Federal Reserve, right? The Federal Reserve of specific region or specific country. So, for example, here in South Africa, it will comes from the Reserve Bank of South Africa. When it comes to United States of America, it will come from Federal Reserve of United States of America. It calls the Feds. When it comes to Europe, it comes the European Central Bank. They are the ones that actually release the inflation data. When it comes to, for example, United Kingdom, it comes from Bank of England. They are the ones that are actually have responsible for inflation data. So inflation data comes in three parts, right? The part number one, it is the increasing of interest rate or a decreasing of the interest rate, right? The part number two is data. It's a data that comes from uh, no. Sorry about that. So the part number one is the data that comes from the CPI, Consumer Price Index, right? Consumer Price Index. That's the data number one. The data number two is the data that comes from Producer Price Index. Producer Price Index is called the PPI. The data number three, it comes from also a retail sales data. A retail sales data. The data number four, it comes from unemployment rate. Unemployment rate. So four data that actually comes from the Federal Reserve, whether it's a Reserve Bank of South Africa or whether it's a US Federal Reserve, Bank of England, the European, central banks. These are four key indicator of inflation data, right? So before the Federal Reserve make a decision in terms of whether they're going to increase the rate of that specific region or they're going to reduce the rate, they need to have this data. They need to receive this data and see how this data it actually going. So all right, let's break down these four data. As a data number one that I explained, it's a CPI, Consumer Price Index. What does Consumer Price Index mean? It's actually consumers. We are the people who are consuming the product that is being produced and or a services. So we are the consumers, right? So that means they are calculating the consumer, how many consumers, how many of us are actually participating in terms of buying. right? So they will release those numbers to say that, okay, this month we have these thousands of people that are participating in the market. What does that mean? It gives us two results. The results number one would give us the idea of how much is being produced, right? The lower sales that you make, it also translates to the lower product that is being produced. That's number one. The number two, the lower sales that you're going to make as a consumer price index released, the lower numbers of that consumer price index released, it actually also translates the price itself of the product. The price itself of the product. If the price is higher, that means maybe a lot of people they're not participating because of the price. It's a little bit higher. Is the price lower? Then why people they're not participating if the price is lower? Maybe the supply now comes to the producers. So that's the data number one. The Federal Reserve they need to have this data to understand so that they can have a gauge to say that, okay, people are participating in a market on a buying. That means there's a little bit of buying power, and now it goes to where they're getting this buying power, right? Now we're going to data number two. The data number two, which is we say this PPI, Producer Price Index. Producer Price Index. This is the index that calculates of producers, people who are producing the product for us to participate or for us to buy as a consumers, right? So they will also release the number of people, the number of Producer Price Index, and to see how much our farmers factories have actually produced a product for people to participate. That data also give us the results to say that if the data is low, that means there was a lower production of a product, right? A lower production of product. A lower production of product can be translated also to two different stuff. One, it can be lack of power in terms of labor. There's no much of people that are being employed to produce the product. The second thing can be the interest rate. The rate has been increased. The ingredients of us to produce that product is becoming expensive, so we cannot afford to buy that type of a product because of it's a little bit of expensive. That's what gives the producer price index data to the Federal Reserve or to everyone who actually participates in the market or who actually pay attention on the economics. So that's very very important to understand how much consumers are actually participating, how much producers are actually producing from the market. All right. So we talk about consumer price index, which is CPI, and we talked about also producer price index, which is PPI, and why the Feds, the Federal Reserve, they actually needs those figures so that they can make a decision regarding the inflation data, right? The third point that I said, the data that is needed, it's a retail sales. The retail sales again, it comes every month. These data they come every single month, so that the Federal Reserve can have, or Reserve Bank can have the idea how the economy is actually moving in that specific region or particular country, right? So the third one we said it's a retail sales, very very important to understand as well. It gives us actually the idea of how much the retail product are being sold in that specific region. Now the reason why the retail is most important because of it's one of the industry that circulate money to each other, to amongst ourselves in a very very short period of time. So you can buy a product, that money can go to the wholesalers, stock the product, come back to the shops, buy the product, consumer buy it, and it rotate that money. So it's very important. It gives us the idea of the buying power of the consumers in that region and how they're actually participating in a market. So that's a third data that is very very important, and the Federal Reserve always looking forward for that data. The last data, it's an employment rate in the United States. They call it NFP. Very very big in places like US and the places like Europe, United Kingdom. when it comes to the economists or the traders. They're always looking forward for non-farm payroll or the unemployment rate. So what it does, this data gives the results of number of people that are actually, employed from specific region from the period of a month, right? So it shows, okay, this month these are number of people they've been employed. Why that data is important? It gives the indication that, okay, these are a number of people that we've been adding to our labor, and that will be able to participate in an economy, that will be able to participate in a retail sales and figures when they're coming, that will be able to participate in a consumer price index when they're actually participating as the consumers, and they will be also participating in terms of tax revenue, because of these are people that are actually employed, and they are going to be cutted tax from there. So it's very important. Then from there, there's a couple of data that comes as well, although it's important, but we didn't mention them. But these are four major data that are very, very important. Most of the economists, they look forward to actually get this data, and so that they can gauge how the market is going to go from the following week or from following month or for a month moving forward, right? So we have seen when it comes to Reserve Bank of South Africa, they haven't been cut the rates, for very, very, increase the rates or cutting the rates. They've been increasing for the 2 years period due to, through COVID-19 all the way up to now, but they haven't been starting to cut the rates up to now. They are waiting for these datas that we've been saying, so that they can have a decision, to cut the rates or to increase the rates. Now, those inflation rate, how does it impact us as, people who are living in a daily basis? So for example, once the Federal Reserve get all these data, they combine the data, and then they see that, okay, right now we need to cut the interest rate, for example. Then they make a decision to cut the interest rate of 25 basis points, for example, right? People who are actually, working, people who are in a labor market, they're gonna have to get the cut of 25 basis points for the things that they do every day. So for example, if you go to a bank and you want to take a finance of a car, if that car, it had, maybe, let's say for example, 70% increase or 70% interest from that, loan. When you take that, 70% will be reduced by 25 basis points, by 0.25%, right? That's what it means. 25 basis points, 0.25 percent being reduced. So 70% in percent increase, I was just guessing, but mostly the rate, when it comes to finance, it's 14%, 16%, 17%, something like that. So same as when you want to buy a house. So if the interest rate is higher now, that means you're going to purchase whatever you are purchasing a little bit higher, and it's not going to be just bigger things like car and a house and a loan. Not only like that, even the food that we're purchasing, the VAT itself, it will be also increased with a 0.25 basis points. If it has to cut, if they cut, it will also reduce with a 0.25 basis points. So you see that the economy, it rotates, right, from the producers who produce, to see the number of producers, that number of product that is being produced, to the consumers who are buying those products, to see the numbers, that how many consumers are participating in the market, to the retail sales, how many retails they are actually selling the product, to give us the sense of circulation of money amongst ourselves. Then to the labor, that give us an idea of how many people are being employed or not, at that particular region. Then give us the indication of they're gonna cut the interest rate or increase the interest rate. Once they increase the interest rate, definitely we'll buy a little bit more. Once they decrease, we'll actually participate a little bit less. Yeah, so these data are very, very important, and the economists are always looking forward to actually understand this data, including the traders that they are participating in a contract of a difference of trading. They want to know where this data is going. What it does to the traders now, it gives them the indication of the instrument that they are trading in a market. For example, the indices that they're going to trade, or the stocks that they're going to trade in a market. The more interest rate is being cut, the more the stocks they're going to have also, stability to start picking up. And what it does again, it does also gives the indication of safe haven instrument like a gold, so that people they're not more participating in a safe haven, because of that time that specific currency it will start getting the, a little bit of momentum. For example, if they cut the interest rate in US, then we will see the dollar a little bit of getting the momentum. If they cut the interest rate in South Africa, then we're going to see the rands getting a little bit of momentum, and a lot of people have the buying power of the product. So yeah, man, that's it. We wanted to talk about what are inflation rates and what are inflation data are, and what does it means, and how does it affect us on our daily living. The more interest rate it goes up, the more we get affected. The more it's less, the more it's